Whenever we look online, it seems like there's another person telling you that they're making so much more than the average salary. And whenever it comes to making extra money, it seems like there's always a catch, and it's never actually how people describe it to be. So in this video, I'm going to show you the different ways in which you can make money with trading 212 or really any other stockbroker. I'm going to go through 2 levels with each example. The first one is £100 a month. This will just give you a little bit more extra money per month that you can spend on whatever it is that you want. The other is a target of £2,000 a month, which in the UK, if you can earn £2,000 a month outside of your job, you could be in a much better position to potentially leave your job or in some cases actually retire with £2,000 per month. So like I said, I'm going to be using the Trading 212 app, but realistically, this will work with any other stockbroker that you prefer. Now in the UK, if you use an ISA, which stands for Individual Savings Account, if you use an ISA, you can keep most of your money. So therefore, we're not going to be talking about tax taking away from our earnings. If you would like to sign up to Trading 212 and receive a free fractional share worth up to £100, all you have to do is to use the link in the description box down below. Alternatively, if you've signed up to Trading 212 in the past 10 days but haven't received a free fractional share, all you have to do is to click the 3 horizontal line menu over here. Scroll all the way down until you see the section use promo code. And in this section, just use my code JUBAIR and you should receive a free fractional share. Now on Trading 212, there are basically 4 ways in which you can make money. I'm going to go through each one of these and I'm going to tell you realistically how easy it is to make money like that. However, this video is not financial advice and you're going to learn very quickly how unrealistic it is to make an extra £100 or an extra £2,000 without actually having to either have a lot of capital or actively be doing some extra stuff. Now with a broker such as Trading 212, the main way that you're going to be making money is by setting a large portion of cash or money that you do not need for the time being into some stocks or shares. There will be a fair amount of risk here because technically you can lose all the money you put into investments, but the potential reward is that you could be making some extra cash per month or per year, however it works out. Now on Trading 212, you can buy a whole range of different things called stocks, and essentially what a stock is a share of a company. For example, Microsoft, you can buy a part of the company, and because you own a share in Microsoft, even though it could be a very, very small part of the company, when the company generates profits, you can benefit from that too. However, if the company generates losses, you can also lose money there. Now, the first way that you can generate a recurring income on Trading 212 is by investing your money into companies that pay out dividends. Now, for example, if I go into this company, Microsoft, you can see that I can invest my money into Microsoft, and by looking at the graph, we can see the value of the company is going up and down. However, let's say if we had invested our money in 2019 into Microsoft, we would have bought it at $150, $60-ish, and today it will be worth a lot more. We could have sold those shares and made basically money. However, that wouldn't be really a recurring profit. So one thing that we can do is to invest into a company like this for its dividends. Now, if we scroll down, you can see that Microsoft currently pays out 0.77% basically of its share value in terms of dividends. Now, if you don't understand what a dividend is, like I said before, when you invest into a company and it is profitable, you can benefit from it, whether its share price goes up or that they pay out dividends. And dividends are basically a share of the profits that the company makes. Companies tend to give out dividends as an incentive for their shareholders to keep the stocks instead of basically selling them off. The longer they hold these shares, essentially the more dividends they will be getting out, a share of the profits from the company. So the percentage becomes incredibly important here. 0.77% is very low. However, we can find companies that do pay out a bit of a higher dividend yield. On Trading 212, there are these things called pies. Now, if we go here and go into pies, we can see that pies are basically a collection of different companies that users on Trading 212 have created that will have a specific theme for investing. For example, the most common pie on Trading 212 is called the Almost Daily Dividends pie. As you can see here, 146,000 people have copied this pie and are investing into it basically. Now, the reason why I mention this pie is because of its popularity. Dividends has become a really popular buzzword when it comes comes to investing. People hope to be able to pay for their bills by investing into dividend paying companies. And then these dividends are paid out quite regularly, usually 4 times a year. So when you see the dividend yield, that is the total sum of basically what you're going to get for the year, not per month or per week or whatever you might have thought. Now, as you can see, this pie actually invests in 50 different companies and they all pay out dividends at basically different points throughout the year. On average, each company pays around 4 times a year, quarterly usually. So this pie basically invests in 50 companies with different dividend payout dates throughout the year. So basically by investing into this pie, you can receive dividends on a very regular basis. Usually every week, most days you are getting some sort of dividend. Now, as you can see, Microsoft is one of these companies, but there are so many different companies. For example, many consumer staple companies you may have heard of. Even something like IBM here, that pays a dividend yield of 2.55%. Now, in order to get a recurring amount paid to us, we have to look at the yield of any sort of investment, whether it's property or stocks. Now, please always do your own research and realize the pitfalls of certain investments. Over here, we do have a percentage amount that we could potentially expect, but these are usually very inaccurate. As you can see, this pie could potentially generate around 10% yield per year. So if we have £100,000, we could expect maybe something around £10,000 per year. But again, these numbers are often very unrealistic and they're just generated by previous past performance results, and that can't always be an indication for future growth. Now, one thing that you have to note is that these are American companies. So if you invest into American companies, when the dividends are paid out, you will have to pay a withholding tax of around 15%. So you're not going to keep the full amount of dividends paid out to you. On top of that, there will be some sort of currency exchange. So if the differences in currency between the country you are investing in and the country you live in does change, then that could affect the amount you can also receive. So from the same pie maker, we can see that there is also a pie created for UK investors where you might not have to pay that withholding tax. Also, UK companies tend to pay out a much higher dividend yield than on average US companies. For example, we have Rio Tinto. And if we scroll down, we can see that Rio Tinto currently pays a dividend yield of 6.73%, which is actually pretty high. Now, 6% is considered a very high dividend yield. So let's take 4% as our number. So potentially we can find a company that pays out 4% in terms of dividend yield. Now, if we want to make £100 per month, we need to invest £30,000 into a company that pays a dividend yield of 4%. Now, the difference between £100 a month and £2,000 a month is 20 times. So all we have to do is to times the number 30,000 by 20 to get our figure for £2,000 a month. So basically, we would need to have invested £600,000 into a company that pays a dividend yield of 4%. Now, let's talk about how realistic that is. So for the average person, £30,000 is actually a very large number, and having just saved that or invested that isn't really easy. Just to get another £100 per month, that is a lot of money that you are risking for the potential benefit of making £100 per month. Now, in addition to that, you're not just receiving money from dividends. If the company also grows, for example, you can see Rio Tinto has shown some growth over the past few weeks and months. Now, if the company grows later, you can sell that for a profit too. So you're receiving dividends as basically passive income, and then future growth as income that you can actually realize by selling. Now, let's talk about the obvious disadvantages of actually doing this. If you have £30,000 and you put it into just one company, that will be incredibly risky. You're not diversifying. But even if you found a basket of stocks that give out on average a yield of 4% and you have diversification, the problem here is that dividends are not guaranteed. Any company can actually take away its dividends being paid out at any point in time, especially if that company reaches financial hardship. It wasn't too long ago when Shell actually stopped their dividends for a bit, but now you can see they are back with 4.4%. So companies can stop dividends at any time. Now, the other main thing that you have to consider is that dividend yield is directly linked with the share price. This means that if you are investing into companies that don't do well long term, then you won't be receiving reliable dividends from them, and therefore not only will your capital be at risk, but your monthly income is not going to be constant. Now, there's another thing to note when investing in companies with very high dividend yields is that often this could be something called a dividend trap. Now, I'm not saying Shell is a dividend trap, but sometimes you will see companies paying out 11, 12, 13% dividend yield. That entices people to invest into them, but the underlying company is not very profitable at all. In fact, mostly making a loss. So you're actually going to be losing money in the long term. You're putting your money under a considerable amount of risk without even much future reward. Another thing to note with dividend paying companies, if a company is so focused on paying out its shareholders in cash, that cash can no longer be used to reinvest back into the business. So typically speaking, companies with very high dividends are either very established companies with really reliable moats, or they are sacrificing their future growth for dividends to be paid out. That is something you have to consider. You can alternatively invest in companies that reinvest all of their profits back into the business and then grow really fast. Or you can focus on companies that pay out dividends. In my opinion, I personally will not focus on dividend yield ever. If that's a bonus, but that's just for me. Now, the other way to make money on trading 212 is by just having cash. Now, let me explain. If you go over to this menu over here, you can see that with trading 212, they actually pay you interest for just having cash. Cash is basically money that you don't have invested into the market. Now, if I go onto my main screen, you can see currently I have £2,519 in free cash. Trading 212 also pays out cash on your stocks ISA and your invest account daily. As you can see, that is 33 pence per day. You can also see just the other day I held £115,747 here, and that was a daily interest payment of £15.16. So that is basically £450 per month or £5,400 a year. So if you want to earn an extra £100 per month, you're going to need £26,100 in uninvested cash. And if you want to make another £2,000 extra per month, you are going to need £522,000 for that. Now let's talk again about how realistic this is. Yes, Trading 212 is currently giving out 4.9% as an annual equivalent rate. Now, as you can see, the rates are changing from the 1st of March. If you're watching this later, the numbers are actually not that important because they will change quite a lot. Typically speaking, interest rates are always very low on cash, and this number is going to continue to keep going down until eventually maybe it will hit just 1%, meaning you'll require a huge amount just to make £100 per month. So in addition to that, most of this cash is put into qualifying money market funds, as you can see in a BlackRock fund and a Goldman Sachs fund too. The numbers here might be all over the place because I literally have just this morning put in all my money, so it will take time for that to update, so don't get confused there. Now, with the rates dropping and will continue to drop, it really becomes quite unfeasible to expect a constant amount per month from having uninvested cash. And the main disadvantage of having just cash is, of course, cash is typically a bad investment compared to the stock market, where the returns have pretty much on every single occasion in the long term, the stock market beats out on just holding cash. So speaking of long-term investing, the third way you can make money on Trading 212 is actually by long-term investing. Now, this is something a lot of people will not want to hear because in order to make money, it actually takes a very long amount of time. We're talking about 20, 30, 40 years of investing regularly, a considerable amount of your income putting aside, not using, and that is a more reliable way of generating long-term wealth. Now, as you can see from my portfolio, I have been investing for over 2 years now. This account is about just 2 years old now. You can see my rate of return has been a positive 42%, and my return has been over £16,000. Now, this hasn't just been a simple portfolio because I have done an ISA transfer, but basically what I'm trying to say is if you invest for the long term, your investing horizon is long, you can potentially generate long-term wealth by investing in good companies that tend to grow as a function of time. Now, of course, when you're investing, capital is always at risk. It is very difficult to know which companies are going to continue to be profitable. Now, one way in which you can reduce your risk is by investing into a diversified ETF, something like a global tracker or something like I do, which is the S&P 500. Now, I've literally just bought this today as a lump sum, but as you can see over the past year, the S&P 500 has returned 18.17%, this particular fund anyway, and typically speaking, these sort of investments do not ever yield such high amounts, so you can't reliably be expecting to be paid out 18% per year. However, in the long term, the S&P 500 over the past few decades has given around 9% per year. However, you can't really take past performance as a reliable indicator for what the future is going to hold. So with long-term investing into something like a diversified index, a lot of people think they can assume a 7% growth over the long term. Some years in that long term, you might get some losses, for example, 10, 20, 30, 40% sometimes even. As you can see here, if you had consistently invested, even through a market downturn like this was a pretty big downturn, and you keep investing, you can reduce your average buying price. And as long as you are consistent, you can see that eventually some markets do tend to go back up, and then the value of the shares you owned from before increase in value and the amount of your portfolio increases. So basically, if you want a monthly recurring income with long-term investing, it is not that simple because you're going to have to sell off bits of your portfolio in order to actually give that sort of monthly income. Now, let's assume we can be making 7% every single year over the long term from something like a global index or even the S&P 500. With 7% per year, if you want to make £100 per month, you will need £17,150. Now, for £2,000 per month, this figure increases drastically to £343,000. Now, for the average person, these figures can seem quite high, but if you are consistent with your investing, you can see in the shorter term that your money starts to compound, and this is the compound interest that will lead us to long-term wealth. But this will take us many, many years, at least 20 to 30 years, typically speaking, although you can see the benefits of compound interest in a much shorter period of time, typically. Now, because we are talking about long-term investing, one thing that plays a major role in reducing the amount you're going to get is inflation. For this reason, we are going to have to take out a bit from our per yearly amount to account for inflation and other factors. So typically speaking, we could probably just take out 4% per year when it comes down to retirement. So if we want to make £100 per month in our retirement when it comes down to selling off our shares, we will need at least £30,000 of a portfolio, very similar to the dividend example that I showed in the beginning. For £2,000 per month, we're going to need £600,000 of a portfolio. Now let's talk about how realistic this is. Now, of course, this takes a very, very long amount of time. So for the average person, they might not be patient enough. Also, we need to evaluate the fact that, there are risks. There is no guarantee that the market is going to keep going up. The other big risk is when it comes down to retirement, there could be a market crash causing a 50% loss in your value. And then if that's the time you decide to sell off your portfolio, then of course you're going to get a lot less than you expect. £100 a month could turn into £50,000 after that long of a waiting period. Of course, there are other risks. What if the stock market completely crashes? What if certain countries disagree to trade with each other? Then that could affect a lot of things. But with investing, your capital is always going to be at risk. There's no real way of mitigating that, unfortunately. Now, the last way of making money on trading 212 is part of the name, and that is by trading stocks on a very short term period. Now, as you can see from Microsoft, I'm using this as an example quite often, but I have no association with Microsoft, of course. You can see that over any time period, whether it's a day, 5 minutes, 1 minute, 10 seconds, the stock market goes up and down because people are buying and selling. Now, if you've heard of day traders, they make a living, or try to make a living anyway, out of the volatility of the market. Essentially, what they're trying to do is to buy low and sell high. The difference between that, otherwise known as arbitrage, that's when you want to buy low and sell high. For example, on eBay, if you buy socks or whatever for £5 and you sell for £10, that's the arbitrage. You profit the difference between that minus the fees, of course. Now, as you can see, a lot of people try to do this per day, and that's why the market moves so much, also for other external reasons too, of course. Now, if you can make 0.5% per month, which I think if you're a good trader, you could easily make that, then in order to make another £100 per month, you're still going to need £20,000 to start with. And for £2,000 a month, you're going to need £200,000. Now, of course, you can decide to compound those gains and make your portfolio a lot higher. And so with trading, it's really hard to calculate exactly. It really depends on the individual. However, let's talk about how realistic this is. Now, the thing is, everyone in their head at some point probably thinks they will be a great trader, but actually trading is a very difficult thing. This is because the markets are very unpredictable. Even the best trader knows this. And realistically, anyone can make a few trades that are positive, that give you profit. But for example, if you started trading here for 2 years, there was a huge loss, meaning you really can't do much if there is a huge loss and you've just made a huge loss on your account. You can either choose to sell off your holdings, resulting in a massive financial loss, or you'll just have to wait it out. But getting 0.5% per month, even as simple as it sounds, is actually a very, very difficult endeavor. And I would not be recommending this, although you can do whatever you want with your money. Now, you can technically trade within your stocks and shares ISA and everything remains tax-free. However, there aren't really that many instruments that will help you with your trading, for example, leverage and stuff like that, which I'm not going to be talking about in this video, within the stocks and shares ISA. That being said, I personally have been doing a little bit of trading with Trading 212 within my ISA, and so far I've realized a profit of £14,118 over the past 2 years, which I'm really, really happy about. But if I had to choose one way which I should be making my money from Trading 212, that would be just here long-term investing, as I think personally that is the most reliable form. Dividend investing is not something that I particularly will get into, neither is just leaving all my money as cash. Trading is something that is fun, however it is a very unreliable form of income, and the downsides with trading are that you could actually buy at the wrong time, the markets go down and you will never have a re-entry point. So I will actually not recommend that. So make sure to check out some of my other videos and I'll see you in the next video.